Hello and welcome to The Pitch, brought to you by Livewire Markets. I'm Ali Selby and today we're joined by VanEck Australia's Alice Shen for an insight into why she's feeling bullish on the outlook for Chinese equities right now. Thank you so much for joining us today, Alice. Really excited to feature you in some Livewire content.
Thank you, Ali, for having me today.
Okay, let's get straight into it. China is currently facing a debt deflation and property crisis. What is the government doing to combat this, and can that instill confidence in investors?
China is still not out of the woods yet in terms of its deflationary problem and the local government debt issue. I think the government is trying to do whatever they can to firefight, and a lot more hand-holding is required. In terms of the local government debt issue, I think the most likely scenario will be some sort of debt restructuring to swap out some of the implicit debt accumulated by the local government financing vehicles by issuing the so-called special resolution bonds. On the extreme scenarios, some of the Chinese banks could also absorb some of the debt. And in terms of deflation, if we look at the CPI figures for the January, it is still very much in the deflationary territory. However, bear in mind that the Chinese New Year last year was at the end of January, so we are coming off of a high base. Overall, we think that if the government is able to push up the aggregate demand for consumption and investment, then confidence and sentiment can improve from there.
Okay, it's also facing issues with youth unemployment, and there's also continued tensions with Taiwan. How does that impact China's economy and its listed companies?
So China's labor market is facing a skill set mismatch at the moment. On the one hand, you have university graduates who would like to opt for white-collar jobs. But on the other side of the equation, the private sector growth has really been stagnant for the past few years, not only from the pandemic, but also the ongoing policy risk overhang. From our perspective, we think that a more supportive tone from the top to these private sectors will be a very good first step. And from there, entrepreneurs will be more encouraged and more willing to start developing, innovating, as well as investing back into the economy.
You talked about, I guess, quite a lot of risks on the horizon for China, and there's obviously a lot going on there, but valuations are incredibly cheap right now. Is the Chinese economy too big for investors to ignore?
China's equity is trading at below 10 times on a forward PE basis, and it is at 5th percentile at the moment. So that looks really attractive. Even for some of the new economy sectors, such as healthcare and IT, they are trading at historical lows as well. So there's definitely huge potential there, and we believe that China could be an opportunistic buy for the Year of Dragon.
Okay, does that have an impact on Australian investors? Obviously, some of our biggest companies have exposure to China. How does that impact us as local investors?
We think that infrastructure investment in China will continue to be a driving force for China's GDP growth this year. And iron ore prices have proven to be quite resilient this year. And we think that the likes of Fortescue will continue to benefit from this tailwind. And even on the consumption front, Chinese consumers still very much like their red wine at dinner tables. So it is expected that the tariffs for Australian wine is going to be lifted early this year, and that could be a major catalyst for Australian winemakers too.
Okay, well, thank you so much for your time today, Alice. I really enjoyed this chat.
Thank you, Ali.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.